Meet Alan, 32 years old, makes 70 grand a year doing something with spreadsheets that he couldn't explain to you if you asked. He's been investing for 6 years, every paycheck, a chunk goes straight into his index funds. He's done everything right. And his account just crossed $48,000. He does the math one night after his third beer and realizes at this rate, he'll hit $1 million right around the time he turns 78. He considers throwing his laptop into the ocean. Here's what Alan doesn't know yet. In exactly 11 years and 4 months, something breaks in his account. Not in a bad way, in a way that will permanently change his relationship with money, with time, with work, and with the phrase, "I can't afford it." He doesn't see it coming. His financial advisor doesn't mention it. No one at his job talks about it. But when it happens, Alan will stop being the engine of his own wealth, and something else will quietly take the wheel. That moment is $500,000 invested. And today I'm showing you exactly what happens when you cross it. My name is Nick, and on this channel, I break down the math the rest of personal finance YouTube is too scared to actually show you. If that sounds like your kind of thing, do me a quick favor and hit that subscribe button before we get into this, because what I'm about to walk you through is the single most important number most investors will ever hit. And almost nobody explains it honestly. Let's go. Now listen, if you're watching this channel, you're probably somewhere between $20,000 and $200,000 invested right now. And this video isn't some tour of rich people's problems. This is a map. This is the finish line you're actually running toward. And I want you to understand what's waiting for you when you get there. Because the people who understand this math before they hit $500,000 get to $500,000 about 4 years faster than the people who don't. That's not an exaggeration. That's a documented behavioral finding. Stick with me. Let's start with the thing that nobody on YouTube talks about in plain English, which is the crossover point. $500,000 invested in a boring S&P 500 index fund, earning the historical 10% annual average return the market has delivered since 1926, generates roughly $50,000 a year in growth, on autopilot, on money you already have. At a more conservative 7%, you're still pulling 35 grand. At 8%, 40 grand. Now ask yourself what the median personal income in the United States is. It's about $42,000. So at the S&P's long-run average, your portfolio at $500,000 invested is earning more per year than the median American earns at their job. Your money is out-earning most of your coworkers without showing up, without going to meetings, without sitting through Brad from marketing's PowerPoint where he asks for the 4th time this week if everyone can see his screen. Your capital has now officially become a better employee than you are. This is what economists call the crossover point. It's the moment your invested capital produces more wealth per year than you can reasonably save from labor. And this is, mathematically speaking, the most important milestone in your entire financial life. Because up until this point, you were the engine. Your discipline, your savings rate, your skipped dinners out, your automatic transfers, that was doing the heavy lifting. The market was a sidekick. After $500,000, the engine switches drivers. You're the sidekick now. Your job isn't to build the machine anymore. It's to feed it, protect it, and above all, not wreck it. Let's check in on Alan. He's now 38. 6 years have passed since that beer-fueled meltdown. His account is at $187,000. And here's the thing. Nobody warned him about. The jump from $48,000 to $187,000 took 6 years. The jump from $187,000 to $500,000 is only going to take 5 because the math is starting to shift underneath him. He doesn't feel it yet, but the engine is warming up. There's a quote from Charlie Munger, Warren Buffett's late business partner, that I can't stop thinking about. Back in the late 90s, he told a crowd, and I'm paraphrasing, the first 100,000 is a bitch. You gotta do it. I don't care what you have to do. Like walk everywhere, don't eat anything that wasn't bought with a coupon. Find a way to get your hands on 100 grand. After that, you can ease off the gas a little bit. Munger's 100,000 in the late 90s is about 200 grand in today's money. But The principle is permanent. The first chunk is the hardest because you're doing 100% of the work alone. You're pushing a boulder up a hill, and the boulder is full of your own savings, and you're not sure if anyone's watching or if this is just some elaborate prank being pulled on you by the adult world. Here's what the math looks like for someone contributing $1,000 a month at 8% returns. $0 to $100,000 takes about 7.3 years. $100,000 to $250,000 takes another 7.8. $250,000 to $500,000 takes about 6.8, and $500,000 to $1 million takes roughly 7 years. Look at that pattern. The last 500,000, the leap from $500,000 to 1 million, takes almost the exact same amount of time as the first 100,000, despite being 5 times larger. That's not a typo. The final stretch of your first million takes about as long as the first 10% of it did. That's compounding, finally showing up to the party it's been blowing off for 15 years. And here's something wild that almost nobody on finance YouTube mentions. Once you cross $500,000, the compression accelerates again. $1 million to $2 million takes about 9 years on autopilot alone, no new contributions required. $2 million to $4 million takes about 9 years after that. Every doubling starts happening in roughly the same amount of time, which means the richer you get, the more your capital is compressing time into money. You are functionally manufacturing years of future income in your sleep. The $500,000 mark is where that assembly line finally turns on. Okay, here's the part I promised would make you mad. I want you to meet your silent financial enemy, the one that's coming for your $500,000 before you even hit it. It's not inflation, it's not the IRS. It's a number that sounds small and is actually catastrophic, 1%. The average financial advisor in America charges 1% of your portfolio per year. Sounds fine? Sounds fair. It's not. On $500,000, that's $5,000 a year. But here's where it turns into a crime scene. If you invest $500,000 at 8% returns for 30 years with no fees, you end up with about $5.03 million. Same exact portfolio, same exact returns, but you're paying that 1% advisor fee. You end up with $3.81 million. That's a $1.22 million difference, like for 1% a year. A man you've never met who sends you a quarterly statement and calls you once a year to confirm your risk tolerance is quietly taking $1.2 million from your future self. That's not advice. That's a toll booth. John Bogle, the guy who literally invented the index fund, said it best. The miracle of compounding returns is overwhelmed by the tyranny of compounding costs. Fund performance comes and goes, costs go on forever, and it's not just advisors, it's expense ratios on mutual funds. It's unnecessary tax drag in the wrong account. It's the little percentages you don't notice because the statement says account grew by 7.2%, without mentioning it would have been 8.4% if you weren't bleeding sideways into someone else's commission check. Here's the contrarian. Take nobody's going to tell you at your next financial planning meeting. At $500,000, you don't need a financial advisor. You need an index fund, a rebalancing calendar, and the ability to leave your account alone for 30 years. That's it. That's the playbook. Most financial advisors are selling you a service you could replace with 40 minutes of setup and a Google Calendar reminder. And while we're talking about silent killers, let me introduce you to the second one, concentration risk. At $500,000, a shocking number of people have 30, 40, sometimes 50% of their wealth tied up in one single stock. Usually their employers, tech workers, finance workers, early startup employees. They think they're diversified because they own an S&P 500 fund. They're not. They're making one enormous bet on a single company continuing to do well. Ask anyone who worked at Enron in 2001 or Lehman in 2008, or any of the 100 dot-com darlings that vaporized in 2000. They had $500,000 too. They didn't have it for very long. The rule I'd live by at this level is that no single stock should ever make up more than 5 to 10% of your portfolio. No matter how much you love the company or how much they love paying you in equity. All right, let's jump back to Alan. He's 43 now. He just checked his account and it says $512,488. He did it. He's here. He's past the line. And this is where something interesting happens in his brain, because the account is now generating at an 8% return about $40,000 a year in passive growth. His salary after taxes nets him about $52,000 in take home, which means his portfolio is, for the first time in his life, doing roughly 75% as much financial work as his actual career. He's standing in his kitchen at 10 at night looking at his phone and doing the math 3 different ways because it feels like he's reading it wrong. He isn't. This is the moment the options start opening up. And I want to walk you through what those options actually look like, because this is where $500,000 stops being a number on a screen and starts being a set of keys. Option 1 is what the FIRE community calls coast fire. It works like this. If Alan stops contributing another dollar right now at 43 and lets his $500,000 sit in the market untouched for 22 years at an 8% return, he ends up with roughly $2.7 million at 65. At 10%, it's about $4.1 million, even adjusted for inflation at a conservative 4% real return. He's looking at around $1.2 million in today's purchasing power, completely untouched with zero additional saving. He doesn't have to retire. He just has to stop saving so hard. He can take the lower paying job he actually likes. He can work 3 days a week. He can start the business that pays him nothing for 2 years. The portfolio will do the retirement saving. His body gets to stop. But here's the version that I think actually hits. One Friday afternoon, Alan walks into his boss's office. His boss assumes it's the usual. Can I get a day off? Can we talk about the Q4 project? Whatever. Alan says, I'm going down to 3 days a week starting in March. His boss laughs and says, we can't do that. And for the first time in his adult life, Alan just shrugs and says, okay, then I'll find somewhere that can. And he means it. And they both know he means it. That's what $500,000 invested does to a conversation. It's not retirement. It's leverage. It's the 2 magic words, rephrased politely. Option 2, geographic arbitrage. And this one is secretly the most underrated because $500,000 in Manhattan is tight. $500,000 in rural Mississippi is comfortable. $500,000 in Lisbon, Portugal, or Chiang Mai, Thailand, or Merida, Mexico is a genuine early retirement. Portugal's D7 visa requires passive income of about 10,000 euros a year. A 4% withdrawal from $500,000 covers that twice over. Your dollars don't just stretch further, they behave like a completely different currency. The exact same portfolio that runs out in 12 years in a high-cost US city lasts 25 years abroad. Option 3, access to better financial products. Direct indexing opens up around $100,000. Private wealth services at the major brokerages kick in at $500,000. You're not an accredited investor yet. That requires $1 million in net worth excluding your primary home, but you're on the launch pad. Things that were theoretical become available. And here's the thing that ties all 3 of these together. You don't have to take any of them, but for the first time in your life, they exist. Before $500,000, they're fantasies. After $500,000, they're choices. That's the entire psychological shift. Now hold on, because the most important part of this video is coming up in the next few minutes. And if you stop watching now, you're going to miss the thing that ruins most people who actually hit this milestone. Because hitting $500,000 isn't the hard part. Keeping it, growing it, and not sabotaging it, that's where most people quietly fall apart. Let me show you how. The second someone crosses $500,000 invested, their brain does something really stupid. It starts rationalizing upgrades. I've earned this. I've been disciplined for 15 years. I deserve the nicer car. I deserve the bigger apartment. I deserve the trip to Japan. And look, I'm not your dad. Go to Japan. But here's what most people don't realize. Every permanent increase in your monthly spending raises the portfolio size you need to actually retire. If you go from spending $50,000 a year to $75,000 a year, you just pushed your full financial independence number from $1.25 million to $1.875 million. You need to save another $600,000 to fund the lifestyle you decided you'd earned. Morgan Housel puts it like this: saving is the gap between your ego and your income. And the bigger your portfolio gets, the louder your ego gets. Lifestyle creep at $50,000 invested looks like an extra streaming subscription. Lifestyle creep at $500,000 invested looks like a $900 a month lease on a car you'll trade in before you ever own it. Same behavior, different decimal point. One of them is survivable. The other one moves your retirement back 8 years. And then there's the behavior gap. Morningstar runs an annual study called Mind the Gap, and the 2025 edition found that investors consistently underperform their own investments by about 1.2 percentage points a year. The funds they own earn more than the investors themselves do. Why? Because people buy high, sell low, panic during crashes, get greedy during rallies, and generally treat their portfolio like a weather report they need to respond to instead of a tree they need to leave alone. Dalbar's 2025 data was even uglier. The average equity investor in 2024 captured about 16.5% returns, while the S&P 500 delivered over 25%. That's an 8.5-point gap in 1 year. Why does this matter more at $500,000 than at $50,000? Because the dollars are bigger. A 1% behavior mistake at $50,000 costs you $500. A 1% mistake at $500,000 costs you $5,000. Over 30 years of compounding, that $5,000 a year error made consistently, silently steals hundreds of thousands of dollars from your retirement. The single most valuable skill at $500,000 invested isn't picking winners. It's not flinching. It's sitting on your hands while the market has its quarterly emotional breakdown and doing absolutely nothing, which, if you've ever tried it, is one of the hardest things a human can do on purpose. There's one more thing I want to warn you about, and it's the weirdest psychological trap of all. At $500,000, a lot of people get bored. I'm serious. After 15 years of index funds and automatic transfers and ignoring the news, boring starts to feel like stagnation. So they start looking for something more exciting. They get into options trading. They put 10% into crypto. They follow some guy on YouTube who claims he's found a hedge fund strategy that works for retail. They don't call it gambling. They call it diversification, but it's gambling. And the data from the Barber and Odean study at Berkeley shows the most active traders underperform the market by about 6.5 points a year, which on $500,000 is $32,500 of lost returns annually, paid as entertainment. Boring is the point. Boring is working. Don't mess with boring. Let me give you the reality check I promised, because I don't want you thinking $500,000 means you're rich. It does not. At the 4% safe withdrawal rate, $500,000 generates $20,000 a year in sustainable retirement income. 20 grand. That's less than a full-time minimum wage job in most states. If your lifestyle costs $50,000 a year, $500,000 covers you for about 8 to 10 years before it runs out. It's a foundation. It's not a finish line. And here's the part that really stings. $500,000 in a traditional 401k isn't actually $500,000. Net of the 22% effective tax rate you'll pay on withdrawals in retirement, it's closer to $390,000 of spendable money. Roth, $500,000 is the real thing. Traditional $500,000 is smaller than the number on your statement suggests, and most people don't realize it until they're already making withdrawal decisions they can't undo. According to the Federal Reserve's survey of consumer finances, less than 5% of American households have $500,000 to $1 million in retirement assets, and under 5% exceed $1 million. So if you're at or near this number, you're genuinely rare. You're in the top 10% of American wealth builders. You're not rich, you're prepared, and there's a massive difference between those two things. Let's close out with Alan. He's 60 now. 17 years have passed since he crossed $500,000. He did 3 things right. He fired his financial advisor at 45 and switched to index funds. He didn't let his lifestyle inflate when his portfolio did. And when the market crashed in 2029 and 2034, he didn't sell. He just kept buying, kept automating, kept ignoring the news. His account today, $2.41 million. He contributed less than $140,000 total in the 17 years after hitting $500,000. The market did the other $1.77 million. His money did roughly 13 times more work than he did. That's the payoff. That's what the engine looks like when you let it run. Meanwhile, his coworker George hit $500,000 the same year Alan did. George bought the lake house, upgraded both cars, kept his 1% advisor, and panic sold twice during the 2029 crash. George's account today is $940,000. Same starting line, half the ending balance. George made the same salary as Alan for 17 years. George just kept getting in compounding's way. And here's the part I think about the most. Alan and George were essentially the same person at 43. Same income, same portfolio, same opportunity. The only difference between the guy with $2.4 million and the guy with $940,000 wasn't intelligence, discipline in the first half of their careers, or luck in the market. It was what they did in the years right after they hit $500,000. That's the window. That's the one that matters. The first 15 years of saving build the machine. The next 15 years decide whether you keep it. So here's the thing I want you to actually take from this. Before $500,000, you're building the engine. After $500,000, the engine builds you. Your entire job switches. You stop saving harder and start behaving better. You stop chasing returns and start avoiding mistakes. You stop looking for the next hot stock and start looking for the exit ramp from lifestyle creep. You become a custodian of something you already built instead of a construction worker still laying bricks. And if you're not there yet, hear me clearly. The hardest part of this whole journey is the first $100,000 because you're doing all the work alone. Everything after that gets easier, faster, more automatic. $500,000 looks like a mountain until you're standing on it. Then you look down and realize most of the climbing happened in the first third of the trip, and the rest was just not quitting. The machine just needs time. Your only job is to keep feeding it and stop trying to help. I'll see you in the next one.